When raising equity to fund their deals, commercial real estate investors and private equity firms will often put together what's referred to as a private placement memorandum, or PPM for short, that clearly describes the property being acquired or developed, the partnership structure that investors will be subject to, and the information on the rights and responsibilities of the sponsor running the deal. But in these private placement memorandums, one of the most important sections that I often zoom in on is the section that details out the biggest risks of investing in the deal and where the biggest exposure lies for investors if things go sideways at the property. And even though every deal is different, I've noticed a few very concrete patterns in risk factors that exist across almost all deals in commercial real estate. And in this video, I want to walk through 4 of the most common and impactful risks associated with investing in commercial properties that I've seen throughout my 10-year career in the business, and how seasoned real estate investors go about mitigating these risks to protect their downside in a worst-case scenario. So the first risk on this list is something that I don't talk about all that much on this channel, but especially for investors considering investments outside of commercial real estate, this point is extremely important, and this is risk related to the lack of liquidity of an investment in real property. Unlike ownership in stocks or bonds, in most cases, you can't just trade in and out of your interests in commercial real estate, and going through the process of selling a property can often take a very long time. Most commercial real estate investors will take 1 to 2 months just to pick a broker to list the property, another 1 to 3 months cleaning up operations to prepare for the marketing process, and then another 2 to 4 months to find a qualified buyer, work through due diligence, and ultimately close on the transaction, resulting in what is often a 4 to 9 month time frame in total from the time an investor decides to put a property on the market to actually closing on the sale. This is why you'll often see institutions and more conservative investors strictly keeping their focus on core primary markets like New York, Chicago, San Francisco, Boston, and other major, heavily populated metros, since these markets often have active buyer pools regardless of economic conditions, which can help a lot in mitigating this risk during recessions when equity investors often start to pull back on deals in secondary and tertiary markets. Now, liquidity from a market of buyers is important when you're trying to get out of a deal, but the availability and cost of capital in the debt markets is also extremely important, which is directly related to risk number 2 on this list, which is risk associated with debt financing of a commercial real estate investment. One of the most commonly cited risks in PPMs is the risk associated with the refinancing of a property, essentially saying that if property values have fallen at the time the original acquisition loan matures, investors run the risk that new loan proceeds from the refinance wouldn't be able to cover the entire outstanding loan balance, and investors would need to come out of pocket with an additional equity investment to cover the difference. Interest rates are also a key component in sizing loans, or the process lenders use to determine the total loan proceeds they're willing to issue to a borrower, which makes changes to interest rates very relevant during the refinance process. Many lenders are focused on maintaining a minimum debt service coverage ratio, or the number of times over the property's net operating income can cover its scheduled debt service, and since higher interest rates result in higher debt service payments, this means that loan proceeds will inevitably need to decrease in these scenarios in order to keep that same buffer between the property's NOI and the monthly debt service owed. And aside from just refinance risk, with interest rates rising so quickly over the past 6 months, another very relevant risk right now related to debt is around changes in monthly debt service payments, specifically for investors using floating rate loans. Floating rate debt is subject to changes in interest rates monthly, and in a rising rate environment, this can result in extremely fast increases in monthly payment amounts, and as a result, this can expose investors to significant reductions or the elimination entirely of cash flow available to distribute. Ultimately, this is why risk-averse investors tend to use moderate to low levels of leverage and don't often include a refinance scenario within their analysis at all, or if they do underwrite a refinance, these investors will usually use a much higher conservative interest rate assumption at the time the acquisition loan is scheduled to mature. Now, in addition to risks associated with liquidity and debt financing, there are also operating risks that are common among almost all commercial real estate investment opportunities, including the third risk on this list, which is the risk associated with the tenants that occupy the property. When a commercial tenant vacates their space, that space can often sit vacant for 6 to 12 months or more, depending on the demand in the market for that particular location and the demand for the specific layout and footprint of the suite itself, which, depending on the size of the vacant space, can result in a huge hit to cash flow generated by the property. And to actually lease up a vacant commercial suite, investors usually need to spend money to make that happen, with leasing commissions and tenant improvement allowances incurred by the landlord before the lease even begins, sometimes amounting to the entire first year or more of base rent that's scheduled to be collected. And even though leases are legal binding contracts, there's always the possibility that a tenant could file for bankruptcy, and in those scenarios, the property owner generally won't be able to recover those upfront leasing costs, and in many cases, even uncollected rent payments owed by the tenant will need to be written off. This is why conservative investors focus so heavily on tenant credit and lease term remaining, since buying a property occupied by Google with 20 years left on their lease, for example, removes a lot of this uncertainty that inherently comes along with the investment in a property that's occupied by a local unproven startup, for example, whose lease is scheduled to expire before the property is projected to be sold. And finally, risk number 4 on this list is also related to the operations of the deal, and this is the risk associated with operating expense increases at the property that can significantly decrease cash flow and returns. This is actually something that many commercial real estate investors are struggling with right now, with year-over-year inflation numbers clocking in the high single digits, and the price of labor, building materials, and other goods and services necessary to run a commercial property increasing substantially over the last 12 months. And while labor and material costs have a clear impact on things like payroll and repair and maintenance costs at a property, these things also directly impact expense line items like property taxes and insurance, which are often two of the biggest operating expenses incurred by commercial real estate investors. On the property tax front, increases in building and material costs have slowed the supply of new product in many markets across the country, which has resulted in property values seeing huge spikes over the last 18 to 24 months. And when these properties are reassessed for tax purposes, this can result in a big hit to income for investors in those deals. And since insurance costs are based on the insurer's potential exposure if disaster were to strike and some or all of the property had to be repaired or rebuilt completely, these increases we've seen in the cost of labor and materials have also led to increased insurance premiums, causing another spike in operating expenses for commercial real estate investors. This is why conservative investors will often look for properties with a tenant base that already has an extremely healthy balance sheet, whether those are creditworthy office, retail, or industrial tenants, or high-income individuals or families that could take on a corresponding increase in rents or operating expense reimbursements if the cost to operate a property for the landlord increases significantly in the future. At the end of the day, commercial real estate investing can be extremely profitable, but just like any other investment vehicle, there are inherent risks associated with investing in commercial properties that are worth digging into further before investing in a deal. And if you're looking to learn more about identifying these risks and want to learn how to analyze a potential real estate investment opportunity that might be thrown your way in the future, as always, make sure to check out our all-in-one membership training platform, Breaking the CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, our entire library of pre-built acquisition, development, and waterfall models for multifamily, industrial, office, retail, and mixed-use deals, and you'll also get access to private, one-on-one, email-based career coaching if you're looking to break into the industry and want some additional guidance and feedback along the way. And if you like this video and want to see more content on this channel on the risks and opportunities in commercial real estate investing today, make sure to hit the like button to let me know, and let me know in the comments what you see as the biggest risk to the commercial real estate industry over the next 6 to 12 months. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.